Welcome back, everyone, to the Joseph Carlson Show. Yesterday, the Fed Chair, Jay Powell, had the FOMC meeting where he declared that interest rates are going to be held the same. The market was expecting that. They were pricing in that interest rates were going to be flat. But he also was a bit more hawkish than expected, and the suggestion now is that interest rates might remain higher for longer, or even higher indefinitely, forever. Now, of course, we don't know the future, but that's what the market's pricing in. And as we can see over the past couple of days, the market has been falling. Just today, the Nasdaq's down 1.11%, the S&P 500 is down 1%, the Dow Jones is down 0.5%. And then over the past week, the S&P 500 is down around 4%, the Nasdaq's down over 4%. So we have a bit of a sell-off. Stocks are trading down a little bit. I want to go over my plan during this change in Fed policy, higher interest rates, and how I view this, as well as an update on my portfolio. So we're going to be looking at everything that I'm doing. Now, the first thing that I'll mention is when you first get into investing, the impression is that you have to really pay attention to the Fed and base your investment decisions around what the Fed is doing. Because it's the all-powerful Fed. They control the market. They have the levers that control the economy. That's not necessarily true. In fact, there's quotes from Warren Buffett where he said that even if he knew what the Fed was doing in advance, he wouldn't do anything differently. He would still just invest in the best companies he would find. The Fed might change the opportunity costs, they might make the market trade around in the short term, but overall, Warren Buffett would continue buying highly productive assets for the best price possible. Another important thing I'll mention, especially for newer investors, if you just started investing and you started investing in a new account, the most important thing by far is waiting. Being patient, ignoring all of the doom and gloom news, ignoring all of the bright, flashy headlines. If we look at the actual data here, it shows clearly that patience is the most important virtue in investing. That is the most important skill set in investing. And if you don't have patience, you need to learn patience. Right here we have a chart showing the probability of the S&P 500 going positive over a given timeline. As you can see, on the 1 month timeline, this first one right here, it is a 63% chance. So if you put your money in the S&P 500, you leave it there for 30 days, there's 63% odds that it's going to be positive. Now, that's okay, but that's still a gamble. You have no clue whether or not it's going to be positive or negative in a single month. But then if you wait a year, you have a 75% chance. Still pretty big odds it's going to be negative. Then we have 3 years, it's 84%. We have 5 years, it's 88%. We move on to 7 years in the S&P 500, and you have a 95% chance of it being positive. So at least over 5 years, you're most likely going to be flat to positive. That's it. 5 years and you're most likely there. Now 10 years and you're still at 95%. So there are times and instances where you can still lose money in the S&P 500 over a 10-year period, but it's highly unlikely. Then if we go to 15 years, this is based on history, you have a 99.8% chance of being positive. So investing in 15 years is no longer a gamble. With 1 month, your odds aren't so good. They're in your favor, but they're not so good. With 15 years, this is no longer a gamble. And then over 20 years, there's never been, since 1926, a 20-year rolling period where the S&P 500 has been negative. Not a single time. Now, it could feasibly happen. That's a possibility, but it's incredibly unlikely. So the data here is simple. Even though most of us are focused day to day on the market, making wise choices, buying dips in companies, and doing fundamental analysis, the most important thing by far is simply waiting. Sitting on our butts and waiting a long period of time after we've made those good decisions. If you made the good decision to invest in the S&P 500, just wait. Now, if you're investing in individual companies, here's the strategy that I'm doing. The fundamentals that I look for are companies that have strong organic growth in revenue, free cash flow, earnings per share. I'm investing in companies that are already profitable. I'm not looking for dramatic changes in the company's outlook. I'm looking for companies that have already done really well, and I can look at them doing that again in the future. So we have companies that have really strong revenue growth, free cash flow, and earnings per share. Companies that can demonstrate pricing power. Pricing power means they raise prices above the rate of inflation. I look for companies that are scalable. They can scale up to meet demand, and they can scale down if demand goes lower. Companies like airlines are not scalable. They can't easily scale up to meet demand. So this is an important attribute I look for in every investment. And then I'm looking for companies where I think that the CEO is the type of person that I can trust to be a steward over the cash that I give them, the cash flows of the company, and to reinvest that money wisely into investments that will have very predictable future returns. So having a CEO that's really good at reinvesting the capital is really important. I'm also looking for predictability. And even though this is like the 5th bullet point, this should be the first. It's the thing I look for the most. And then overall, a lot of these companies happen to be service-based monopolies. They're companies that are capital light, highly predictable. They have high barriers to entry. This is the type of company that I'm focusing on in my portfolio. When I make investments into these companies, there's no guarantees that over the next year they'll have positive returns, but given enough time for them to compound, again, having patience and seeing things move and evolve over time, these companies should have growing cash flows. And over time, the price of the stock should follow the cash flows. But either way, even after I select these companies, it's the same as index investing. Patience is key. It is the most important trait. Nothing else comes even close. And this past week, has made investors, I think, a little bit antsy about the market. My portfolios, for example, we have 2 different portfolios here, the passive income portfolio. This one's down, let's take a look. It's down 3% or $15,000 in the past week. Now that's a bummer. It's trading down a little bit over the past week, but if I zoom out a bit, all time I'm up $83,000. And I think if we go another 10 years, I'll be up more and more in the green, despite this recent volatility. If we look at the story fund here, all time it just moved back into the negative. And a week ago, we were in the positive by around $10,000. So in the past week, this portfolio you can see is a lot more volatile. It's down 6.28%. Amazon alone is down nearly 10% in the past week, and then the rest of these companies are also down quite a bit. What I want to do is focus on these tech companies that have been hit the hardest. So we're going to be going through the story fund and my top positions in this portfolio. So let's go ahead and go through each of them. The first one we'll start out here with is Amazon. It's currently a $55,000 position, and I'm in the red by $2,700, so just a hair on this company. Amazon is on a losing streak. From MarketWatch, Amazon stock heads for the longest losing streak in 7 months, after the FTC adds executives to its lawsuit. So Amazon's being sued by the FTC. Lena Khan hates Amazon. She's wrote about the company in college. She really doesn't like that they're skirting all of the laws from the FTC, according to her. I think that they're going to lose that case. I thought they were going to lose the case against Microsoft, and they did. I think they'll lose it against Amazon. They say that shares of Amazon sank another 3.22% today, putting them on track to suffer a 6th straight decline after 3 executives were added to the Federal Trade Commission's lawsuit. So under threat of the FTC, Amazon stock is dropping. Now, I'm not concerned about this. Like I said, I don't think the FTC is going to win. I think they have a weaker case. Part of my reasoning behind that is, in order for the FTC to prove that Amazon is bad, they have to prove that Amazon is hurting customers. That is the big thing they have to prove. Amazon is getting rid of competition, which hurts customers in the end. And I think it's very difficult to prove a company like Amazon is hurting customers. Customers love Amazon. They're addicted to Amazon. They use Amazon willingly because they trust the company. So I think it's an uphill battle for the FTC to beat this company. Now, another reason that I'm not concerned about Amazon, in fact, I'm bullish on the company, is Amazon just announced a couple days ago that they're adding on 250,000 employees and bumping their average pay for the holiday season. Now, if we look at the data here, last year, Amazon only hired an additional 150,000. So they're bumping this up by an additional 100,000 this year to 250,000. Amazon already has 1.5 million employees, and they're tacking on another 250,000 for the holiday. If a company was in trouble and lacked demand and saw things moving in the wrong direction, would that company be bumping up the amount of employees by 250,000, even after having an enormous amount of employees already? Of course not. The only reason that Amazon would add on 250,000 employees during the holiday season is because they see that they have a ton of demand. They're forecasting bigger and bigger demand. That isn't what a company does when they're struggling. Amazon is succeeding. The company is flourishing, and the stock price is going down. Now, one more thing I'll mention about Amazon. Right now, Google's under lawsuit by the DOJ, and part of that lawsuit, they have to share a lot of documents and they have to prove that they're not a monopoly. Well, part of Google proving that they're not a monopoly is pointing out directly from Google, the executives from Google pointed out that they're losing market share in digital advertising to Amazon. Google is saying that digital ad budgets are shifting to Amazon. Now, you can say that, of course, they're saying this because they want to point out that they're not a monopoly, but this is also truthful. It's accurate. The Justice Department is saying that Google's a monopoly and can't be competed against. Google's saying that they can. Google's vice president of advertising products said, quote, "I would not say Google search ads are a must-have for any advertiser. We're losing market share to new entrants like TikTok and Amazon.com. And I've said this for a long period of time. Amazon has the best advertising business of any big tech company, by far. It's better than LinkedIn. It's better than TikTok, it's better than Google, it's better than Meta's. It's better than all of theirs because it's incredibly targeted. None of them have a big search box that you type in a product and then you get sponsored listings right at the top. That is something unique to Amazon, and no other company has this nearly close to the scale of Amazon. This is something that the same person pointed out at Google. This is a Google executive saying Amazon is, quote, able to get better data than we are on the effectiveness of their advertising. That has caused budgets to shift. So if I get this straight, Amazon's in a situation right now where the stock is going down big time. It's going down because of a lawsuit from the FTC. That lawsuit, I think, it's difficult to say that it's going to really damage Amazon. Most analysts don't believe it will damage Amazon. And the FTC's past has been full of failures, failing to beat Microsoft and so many other companies. I think the case against Amazon is even more difficult. Now, if we look at the company and what they're actually doing, Amazon is obviously seeing a lot of demand in their retail business. They have 250,000 new employees joining the company for this holiday season, and Amazon is seeing a shift in budgets for advertising to their platform. Then on top of that, we also can see that AWS continues to grow quarter over quarter. Every aspect of this company is growing, and I like seeing that. So when I see the stock price go down for whatever reason, I'm not concerned about it. I pay attention to the fundamentals. The fundamentals are moving in the right direction. Now, moving on from Amazon, we get to my second largest holding, which is Netflix. This is one that it was in the green just a couple weeks ago, but like all of these more volatile tech companies, it traded down over the past couple of weeks. I'm now in the red by $4,300. The holding value is $34,000. So this still is a significant bet. And this level of volatility, trading up or down $5,000, does not concern me. I've held this company through massive drawdowns, so it going down a few thousand is not a concern. If Netflix continues to trade down, it's not a concern. My concern, again, is about the fundamentals of the business and how things are evolving. Now, the big overhang for Netflix and Disney over the past couple of months has been the writer's strike. Now, writers and actors have been on strike for months, and I've always held the position that Netflix is in the most advantageous position out of all the streaming services with the writers and actors strike. The reason why is Netflix has a huge backlog of content, so even though there's a writer strike going on, they're releasing new shows all the time. Another thing that Netflix repeatedly does is they're just able to dig up some older show that the world has forgotten about. It doesn't have any type of buzz, and Netflix throws it up on their little auto thing where it shows you a clip of the show when you log into Netflix. And then all of a sudden it's like the #1 show in the summer. This was the case with Suits. Haven't you heard a little bit more buzz around Suits than you have over the past decade? This show is literally 10 years old. Netflix licensed it and all of a sudden it's a breakout success, one of the biggest shows of the summer. So Netflix doesn't necessarily need new content all the time. They're able to license shows. They license The Pacific and they license Band of Brothers from HBO. They license Ballers and all these other HBO shows. So they're able to do that. But over time, we do need new shows. So the writer's strike is still something that's overall a negative for this industry. Now, the good news here is that it looks like it's coming to an end. Hollywood studios, writers, near agreement to end the strike. The rumor is that they're going to be ending it tomorrow. So come Friday, we should receive news that the strike is over for both the writers and the actors. If it doesn't happen this week, the rumor is that it will go on throughout the end of the year. So we'll get more rehashed content, more old shows that are being resurfaced, and more unscripted shows like documentaries and, of course, reality TV. Now, I don't want to watch documentaries and reality TV forever, so I'm hoping that they can come to an agreement. But either way, this is short shelf life stuff. This is stuff that impacts Netflix for the next 6 months, for the next 3 months. It's not stuff that's going to impact the fundamentals of this company over the next 10 years. And the fundamentals of Netflix are still well and alive. I keep trying to paint this company as one that literally everyone uses. Everyone loves Netflix, despite what people on Twitter say. We have hundreds of millions of people that actively use Netflix every single day, and more people in the world that want this company's product. If we look at the actual data here, let's go ahead and take a look at this chart here. This is from Alex Morris of the Science of Hitting, and he has a chart of Netflix's active subscribers over time since 2014. In 2014, it was 51 million. So 51 million, a good start, but notice the trend over time. What I notice here is that it's pretty gradual from 2014 to around 2019. Now, we had the pandemic that sped things up quite a bit over this time period, above their normal rate. But then we had a little bit of a slowdown. So the pandemic had a bit of pull forward demand. People signed up for Netflix that normally would not have. And then we had a couple quarters of it being flat. These couple quarters right here, 222, 222, 221, that caused a 70% decline in Netflix's stock. And during this short time period, there were people saying that the story was over. Netflix is completely dead. Of course, that's not the case. I run a subscription business as well. I have Qualtrim.com. That is a monthly subscription. I see that new people join and new people leave all the time. There's people that come in for the free trial, they try it out. Most of them stay, but some of them leave. Then older members, for some reason or another, at some point they leave and then new ones come back. It's a constant cycle of churn and new members all the time. So when I looked at this, the lens that I was looking at it through was running a mini version of a subscription business gives me some insight into how there's people coming and going all the time. That's the nature of a subscription business. Overall, the product was still quality. Overall, everything for this company was still going in the right direction. And then Netflix, after that massive 70% sell-off, continued growth. They have a new ad tier that's adding on members as well, but they went from 223 now to 244 million. The company's sitting right now at 244 million subscribers, and from their own estimates, Netflix management believes they can about double this over the next 10 years, going from 244 million to 500 plus million subscribers. That's pretty good. That's a good story. Now, on top of that, we also have a company that is not only gaining customers, so we have volume count, we have an increase in customers, but we also have pricing power. This chart shows their ARM, average revenue monthly, and this shows the price increases over time. So the blue is the average revenue, and then the green is the price increase over time. Netflix increases prices all the time, and people still keep paying for the product. The number one thing to look for a good company is one that can increase the amount of customers it has while increasing prices. If they can do that at the same time for long periods of time, that is a great company. That means they have real pricing power. Netflix has only ever increased prices over time. Now, they also add in more tiers, but they're still doing a price increase. Netflix actually did a sneaky version of a price increase where they got rid of their $7 tier. They instead replaced that with an advertising tier. So people that churn out of the $7 tier and they rejoin, now they're as part of the advertising tier, which increases the average revenue of the company. So that's a roundabout way of increasing prices yet again. So we have a company that's reaching an all-time high customer count. They're increasing prices over time. They had a slowdown in revenue growth, but they're reaccelerating revenue at the back end of this year. They expect it to be above 10% yet again. So double-digit revenue growth. And then on top of that, they're highly profitable. If we look at the cash flow of Netflix, gone are the days of them having negative cash flows. Now are the days of them having billions and billions of dollars in positive cash flow. In 2022, it was $1.62 billion. In 2023, it's going to be $5+ billion. From 1.6 to $5 billion. This is the result of a business with a lot of operating leverage and now taking on a lot of efficiencies. So overall, when I look at Netflix yet again, and I do an updated analysis on this company, I like the direction everything is going. I think that Netflix is going to be a free cash flow machine, generating a lot of free cash flow every single year, reinvesting that through buybacks, buying more and more shares outstanding, paying down their debt, and then growing in all different ways across planet Earth. So when I look at the company right now, the fact that it's trading down in the short term because of the writer's strike or the latest news, that's not a concern for me. I plan on holding this one for the next 10 years. So when I look at Amazon and Netflix, the way that I see it, I feel very happy with these companies. Despite the short-term trading, I still feel the same way I did when I originally purchased them. And I'm not going to let price action dictate my sentiment and how I view these companies. I think they're going great. Now, the other company that's actually doing well in terms of price is Google. This one's in the green by $5,000. Google's a company that obviously investors are in love with. Far and wide, most investors own this company for good reason. They have a very good grasp on a lot of different important markets, especially the advertising market. But Google's facing a lot of troubles right now, or at least a lot of challenges. One of them is with the Department of Justice. But now that this case has started and it's being argued, we can see what they're actually saying in court. They say that the case against Google is relatively straightforward and also potentially explosive. The Justice Department argues that around 2010, Google began using anti-competitive tactics to maintain an overwhelming search engine monopoly. Already dominant over the alternatives like Bing and Yahoo, it cemented its position with the power of defaults. The power of defaults is the big case of the Department of Justice. Now, when I read that, of course, I think it's applicable to Google because they're the ones under scrutiny here. They're the ones being accused of being monopolistic. But I also think of another company. I think of Apple. Apple is the company that owns the defaults. Keep in mind, the majority of this case is focused on Google striking a deal with Apple to be the default search engine. But Apple's the one that controls who is the default. So if the argument here is that defaults are powerful and the company that owns the defaults are powerful, that's Apple. So this case really is proving how powerful Apple is. More than anything, that's what I see when they're arguing their case against Google. Isn't it ironic that Apple's the company that owns the default position? They can decide which company shows up on all of their devices as default, but yet the Department of Justice is targeting Google for using what Apple is selling. They're saying, hey, Google, that's illegal that you purchased a product, a default position from Apple. To me, that doesn't make much sense. I think they should instead be going after Apple, and I say that as an Apple shareholder. That included paying Apple and Mozilla to make Google the default search engine in Safari and Firefox. Now, of course, paying Apple and Mozilla is one thing, but out of these two companies, who has more influence? Come on, it's all Apple. Google isn't in trouble for paying Mozilla for being the default. They say as it grew, it used vast quantities of search data to improve its engine, creating a feedback loop. The Department of Justice alleges has made it impossible to beat. This case is about the future of the internet, whether Google search will ever face meaningful competition. So the DOJ's argument here, I think, is a silly one because they're blaming Google for basically buying market share. They're buying advertising, both on Apple devices, Mozilla, and Android. But Google's spending money to do that, a lot of money. Other companies could spend the money to do that. A lot of other companies have the cash, but they won't. So I really think that Apple continues to hold the dominant position here. Now, another part of this case that I thought was actually funny. Apparently, the executives at Google instructed people, especially higher up people at Google, to not use specific terms in emails or in communication because it might give off the wrong impression. They say to avoid discussions of scale and network effects. They say we do not use leverage, or we don't leverage anything. Say we don't lock up or lock in. We don't bundle or tie products together. And to avoid metaphors involving war, sports, winning, or losing. Basically, what the Google executives are saying is nobody at Google talk in any type of investing terms or business quality terms. These are all the same terms that most investors use. Always pitting things as wars and winning and losing and bundles and network effects and scale advantage. That's how investors talk. Google executives are saying to not use those terms because the DOJ will use it against us. They'll say that we're monopoly because we're leveraging our advantage, we're scaling up, we're using network effects. Those type of terms don't translate well into politics. So I thought this was a bit funny. In truth, Google has all of these things. They have huge bundle effects, they have huge scale advantage, they have huge network effects, massive network effects, and they are competitive. Whether you want to equate that to war or sports, they're competitive with other companies. So this is another challenge that Google faces, but this isn't something entirely new. They're constantly in trouble with world governments. That's part of investing in these globally dominant companies. I think that Google will still have above market returns given its growth profile, its quality, diversification, and overall the core businesses. Google's cloud computing core business is amazing. Their focus on AI is amazing. They have a lot of potential growth in the future. So I wouldn't become bearish on this company in the future just because of this lawsuit, even though it could be a little bit of a drag in the short term. So Amazon, Netflix, and Google, I like all of them. The price action hasn't changed my feelings on either of them. Next up, we have Microsoft, which is possibly the most boring out of the four. And Microsoft, I don't have anything specific to say. The company is a silent compounder, chugging along in the background. This is such an easy company to own. Looking at the fundamentals and the capital efficiency, the diversification of the business, the cloud business that they have, it's incredible. They're also making a lot of progress into cybersecurity. I believe they're one of the biggest firms at that now. They're growing in so many different ways. So Microsoft is still a company that, despite a lot of people pointing out that it trades at a little bit higher of a valuation, it is proven that it deserves a little bit higher of a valuation. And I still believe Microsoft is worth holding. I'm not going to underweight this company. I'll continue to hold it in the portfolio. Now, the last meaningful position in this portfolio is S&P Global. This is one that I haven't talked about as much in the Story Fund, and I'm going to leave this one to a new episode. I have an in-depth breakdown of S&P Global, why this company is in both of my portfolios, and why it's my largest position in my largest portfolio. This is the company that I've made the most significant bet on out of any company I've ever invested in. And I break down all the reasons I'm investing in this company. So that's going to be a full episode. It will probably be around a half hour long. That's going to be on the main one. So if you haven't, subscribe to that if you're interested. S&P Global, just to give a bit of a teaser here, I believe is every bit of a tech company as Microsoft, Google, Netflix, and Amazon. In many cases, it's more of a tech company. It's more of a data company. It's more of an AI company. It should be right there in the conversations of companies like NVIDIA, Palantir. I really believe this company is a cutting-edge technology company. So we'll be looking at that one in more detail in the future. But that's my update for now. If I had to summarize one point here, it would be to just be patient. Don't worry about the market trading down a bit. These companies are powerful companies. They make gains over time. If you're invested in a growth fund or the S&P 500, just be patient. That's all for now. See you in the next one.